Well, there are really two big factors that are holding back consumer demand. One is confidence, right? If you look at China, people are still wearing masks, they're still worried about going to restaurants, they're going out to cafes, and that is despite the official numbers showing low infection rates. There's this lingering fear that there might be another flare-up. So people are holding back. There's this lack of confidence. The second issue is that China also has seen a rise in unemployment in February. A lot of people have not gotten the job back. A lot of people took a big financial hit, and so that has deprived households of spending power, and you still feel that after effect of that. I think all of that points really to the need that the government just has to inject even more fiscal stimulus, not just during lockdowns, but particularly afterwards to get the economies back on track.
Good morning to you, my friend. Frederic, I've taken your advice and I've looked at your chart 2 on your copy, what you've sent out to a lot of people for 2021. You say it's going to warm our heart. I think it's the most V-shaped thing I've seen for weeks as well. Chinese growth, nearly 8%. Ex-China Asia growth, nearly 7% as well. Across the board, I see green shoots as well. You're way too optimistic, aren't you?
Yeah, well, you know, it's easy to generate those growth numbers in 2021 because the base effect is just so low. So you don't need much growth to get very punchy headline numbers. But what really matters is whether at the end of 2021, we're above the level where we started in January 2020 before this thing broke out. And there are very few countries that, despite very strong growth next year, are even going to make up the lost ground of 2020. China may be just one of these economies that does, but many other economies in Asia, presumably in Europe as well, are going to struggle to, over a 2-year period, to go back where they were, say, in 2019. So it really all depends on what you mean with V-shaped. It looks great on paper, but you know, we're still going to be slightly worse off than we were 2 years prior.
When people look at emerging, and Frederic, I've probably bored you with the same question for years, but I'm going to go there again now. We look at the ones with current account surpluses and the ones with current account deficits, the ones that aren't dependent on international liquidity and the flow of the dollar compared to others. Who are the winners and who are the losers?
Well, in this environment, really, you want to stick with markets that have policy space and have really shown administrative capacity to rein in the virus, been very efficient in rolling out policies. The current account surplus countries are the ones who have policy space, not just on the fiscal side because they don't need foreign borrowing, but also on the monetary side because they can ease policy without having to be worried too much about exchange rate changes. So you have what you have in East Asia, for example, a whole bunch of countries that actually have fairly robust current account surpluses and can thereby roll out a more aggressive stimulus. If you pair that with reforms, efficient administrative programs, you're going to see some of these economies bounce back quite nicely towards the end of this year in 2021. The problem still is with countries that need to borrow internationally. They're more constrained in terms of fiscal stimulus they can administer, and if there's any disruption in global finance, another bout of risk aversion, you're going to see those currencies react much more forcefully than those of the current account surplus countries. So it's a nice divide. It's just the nature in episodes like this. The fundamentals matter, and fundamentals of current account surplus countries are just stronger.